Now, liquidity providers see safe haven gold and silver rising alongside the dollar and bond yields. Obviously, on an intraday basis, you might see that volatility. It might start to because the momentums will jump on it. But guess who's buying that? The same commercials are exposed, and the bullion banks are exposed to outflows of bullion. So the truth be told, Goldman Sachs are very long both physical gold and silver for their own book, and par for the course, clearly don't like the competition, and will be proved to have been driving the gold price up to $3,000 by the end of the first quarter.
We present the clips of Maguire's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
And on why the dollar price of gold at $3,000 and silver at $50 looks far too cheap during Trump's second term. Now, more immediately, Asian buyers have notably stepped up their bargain hunting in both gold and silver, which has been forcing the commercials to begin to ring the register. And remember, we were tracking these automated momentum sellers who control. So basically, they were beginning to ring the register on these guys. But what's happened is following each Asian unleveraged physical buying session, and you can just look at any chart and you see in the morning that Asia buys, then what's happened is then the momentums are happy to take this 96% leveraged synthetic gold, and then they automate selling gold into what has been really a dollar rally, which during the first two sessions of 2025 tagged its highest level since November 2022. So that beggars the fact is, then why is gold not dropping? Well, it's because we're going to go through why. And there's some massive changes going on here. And just as we reported during our end of year market update episode, with no single point have house insiders, had they or are they adding any shorts or making any bearish bets against gold and silver. That's something they couldn't hide in the COT reports that spanned the period since our last episode. COT reports simply being what little information the House has to publish to the CFTC. And this is because the House insiders are exposed to physical delivery obligations from outside the cash-settled COMEX exchange, and because Basel III regulations ultimately force physical delivery, so the House is unable to halt the outflows of synthetically discounted underpriced bullion exiting the COMEX to fulfill global central bank demand. As a reminder, and to update new subscribers, of which we have many, following Basel III NSFR conditions being imposed on the 10 times larger foreign exchange market liquidity providers, every single bullion bank has actually been coattailing every global central bank, except the Fed, that is, and all these first-tier market-making bullion banks went long physical gold and silver, coattailing the central banks, and they went long for their own books, naturally, because they got a view into the physical markets. So when we look at the makeup of what is counterintuitive house insider gold suppression footprints, which we evidenced into the close of the 24-year trade, we're really talking about the three agent bullion banks forced to act on behalf of the Fed, who remain the only global central bank still trying to cap the dollar price of gold. I mean, it's ludicrous, but it's happening under our watch. Now, many of our subscribers' questions during 2024, as you've just elaborated, they sought to understand if the Feds have unlimited pockets, fiat pockets, which they do, So they could really continue to fly. Could they not continue to flywheel this 50-year price suppression scheme, which is what the COMEX was specifically formed to do? Namely, that was after Nixon suspended the dollar's convertibility into gold, into synthetic, so that they could synthetically dilute thousands of tons of gold to dissuade foreign central banks from swapping their unbacked dollars for physical gold, because they were trying to keep the price the price volatile and wrongly positioned. Now, while it's true, that the Fed has virtually unlimited printed dollars to keep the siloed COMEX over 50-year price capping scheme rolling, following Basel III, recategorizing physical gold as a first-year asset class on the 1st of January 2 years ago, almost 2 years to the day, it forced the 10 times larger global-facing foreign exchange markets to back the 17 trillion a year foreign exchange gold offerings with bullion, thereby limiting the house's ability to keep fractionalizing what is a rapidly depleting stock of house leverage bullion bars. Now, despite gold rising by over $600 per ounce, despite their best efforts to dilute the gold price against a rising dollar, all that happened was the Fed revealed its weak poker hand. But following this 50-year legacy gold price suppression, they had little option but to double down. And the problem is that outside the siloed casino bubble, every other central bank is capitalizing on this bluff, busted hand, which is, in poker terms, what it is. Now, the Fed is rapidly running out of the necessary bullion that they rely on to dilute the paper price of gold. Now, despite the ability to leverage their undeliverable casino chips by a massive 96%, it beggars belief, but that is what you're seeing. Anytime you see a trade on the COMEX, it is only 4% backed by any bullion. So what they're doing is despite this ability to leverage to that degree, which is about hiding the fact that the debt-based dollar is actually losing purchasing power as benchmarked by unleveraged first-tier gold, FX gold, that is. So the rubber actually meets the road at global gold fixes, which actually sets the dollar price of billions of dollars of accrued Fed-held derivative bets. And that's what really this is about. It's not just what's being traded on the COMEX. There are massive derivative bets, which these prices are trying to protect. Now, ultimately, the Fed's agent bank losses are insured by the Fed, but as the rising gold price illustrates, this is a losing battle, which will have to be resolved by paying ever higher prices to balance the paper to physical book.
The global gold market had its best performance in over a decade in 2024, and analysts predict that the rally will likely continue through 2025, driven by several bullish factors. Central banks are expected to be the primary buyers of gold as they seek to diversify their reserves amidst a rapidly changing global landscape. Gold prices soared past $2,000 per ounce early in 2024, reaching record highs above $2,700. And as of the first week of 2025, the metal remains strong, trading above $2,600 per ounce. In addition to its safe haven status, silver is also benefiting from increasing demand due to its role in climate-friendly technologies. Despite silver's rising value in tandem with the dollar, both gold and silver face tightness in physical supply, which is expected to push prices higher, driven by real-world market dynamics rather than synthetic market activities. Maguire notes that analysts focusing on synthetic markets are missing the growing divergence between gold and silver and their traditional correlations with the dollar and bond yields. While some analysts, like Goldman Sachs, have pushed back their $3,000 gold price projections to 2026 based on synthetic market expectations, Maguire argues that the surging physical demand for gold will push prices to this level sooner than anticipated.
Putting it all together, So, driven by central bank, sovereign, and institutional safe haven physical demand, gold and silver made significant gains in 2024, with gold and silver prices increasingly being discovered in fully physically backed bricks facing exchanges. And this physical demand will continue to accelerate in 2025. Now, while gold benefited from its monetary role as an investment metal, as has silver attracted similar safe haven demand, though, it has also gained from silver's also gained from the increasing demand for its climate-friendly applications. And we're looking at EV battery advancements, photovoltaics, and etc. There's a ton of it, but it also has been attracting safe haven demand, which is why sometimes we're seeing silver counterintuitively rising alongside the dollar. Now, it is tightness in physical supply at current prices, that is, that will force gold and silver to break out. And under the smoke and mirrors COMEX-driven action is what we're looking at through the physical markets. It is through that lens that is providing us a far more bullish outlook than is being spun by Western-facing analysts. Now, what's not being factored in to current gold and silver price forecasts is both gold and silver are increasingly breaking free of their inverse dollar and bond correlations. So rising bond yields resulting from impossible to justify rising debt levels into a wrong-footed Fed, and I'm surprised there hasn't been a buyer strike yet, and the unknown effect of Trump's upcoming tariffs, again, uncertainty, they're accelerating these dislocations as safe haven demand is these US treasuries and dollars are being converted into gold. Yet the old guard Western-facing analysts, relying on historical correlations to keep on going regardless, blinkered to what's going on, see rising bond yields and a rising dollar as limiting gold's upside because none of them have a view into where real physical prices are being discovered. And if they do, they're deliberately trying to spin it down. For example, while still bullish on gold, at the open of January trading, Goldman Sachs pushed out its 3,000 gold price projections for 2025 out to 2026, based solely on synthetic market expectations that a rising dollar and bond yields will cap gold from rising to $3,000 in the short term. However, all our first-tier liquidity providers, and yes, one is a market maker at Goldman Sachs, assess that they are forced to unwind the forced unwind of dwindling COMEX open interest flowing into markets getting physically settled outside the COMEX continue to evidence the dumping of US treasuries for gold and conversions of the strongest dollar since November 2022. This exacerbates the break in historical inverse correlations. Now, liquidity providers see safe haven gold and silver rising alongside the dollar and bond yields. Obviously, on an intraday basis, you might see that volatility. It might start to because the momentums will jump on it. But guess who's buying that? The same commercials are exposed and the bullion markets are exposed to outflows of bullion. So the truth be told, Goldman Sachs are very long both physical gold and silver for their own book, and par for the course clearly don't like the competition, and will be proved to have been driving the gold price up to $3,000 by the end of the first quarter. Almost certain. We've seen their counterintuitive calls. They usually trade against what they call the Muppets. They've used that term before on their speculators, on their clients.